Index funds versus mutual funds versus hedge funds versus ETFs explained. Have you ever felt a little lost when financial experts start tossing around terms like index funds, mutual funds, hedge funds, or ETFs? It's like they're speaking a secret language, and you're left wondering if you're missing out on crucial wealth-building opportunities. Well, today that changes. In the next few minutes, I'm going to demystify these powerful investment vehicles for you. We'll break down exactly what a fund is, explore the different types, understand how they're managed, uncover the real risks and costs involved, and most importantly, figure out which one might be the perfect fit for your financial journey. This isn't just theory. It's practical, actionable knowledge that most people spend years trying to piece together. So settle in, because you're about to gain a clear understanding of the investment landscape. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. Understanding the core. What exactly is an investment fund? Let's start with the fundamental question. What is a fund? Imagine you and a group of friends decide to buy a vacation home together. Instead of one person putting up all the money, each of you contributes a portion. With that pooled money, you collectively buy the property, share in the ownership, and enjoy the benefits without any single person bearing the entire financial burden or managing every detail alone. That, in essence, is how an investment fund works. It's a collective pool of money from many investors, used to purchase a diversified portfolio of assets, like stocks, bonds, real estate, or other securities. Instead of trying to manage individual investments yourself, the fund handles it for you, and you get to share in the overall performance. This diversification is a powerful concept for risk management, spreading your money across many different avenues. Think of it as having an expert team managing a vast garden for you. Instead of planting individual flowers, fruits, and vegetables yourself, you contribute to a communal garden, and the gardeners ensure it thrives. You benefit from the entire harvest without having to dig, water, or fertilize every single plant. This is a core principle for long-term wealth creation. The passive path, demystifying index funds. Now that we understand the basic concept of a fund, let's dive into the types, starting with one that's been making waves in the personal finance world: index funds. You've probably heard people say, just put your money in an index fund and forget about it. But what does that really mean? An index fund is incredibly clever because it doesn't try to pick individual winning stocks. Instead, it simply mirrors or copies a specific market index. What's an index? Think of it as a meticulously curated list, a benchmark that represents a particular segment of the market. For example, the S&P 500 is an index that tracks the performance of 500 of the largest, most established companies in the United States. When the S&P 500 goes up, it generally indicates that the broader market is performing well. There are many other indexes out there. The Nasdaq, for instance, is famous for tracking technology giants like Apple, Microsoft, and Amazon. The Dow Jones Industrial Average, or just the Dow, follows 30 large, well-known companies across diverse industries, from Coca-Cola to Boeing. You can also find indexes for small companies, international markets, emerging economies, or even specific sectors like healthcare or energy. The idea is simple: no picking, no guessing. Index funds are considered passively managed. This means there isn't a team of high-paid managers actively deciding which stocks to buy or sell. They simply follow the rules of the index. And this passive approach is a huge advantage because it keeps fees incredibly low. Most index funds charge an annual fee, known as an expense ratio, ranging from as little as 0.02% to about 0.2%. To put that in perspective, if you invest $1,000, you might pay as little as 20 cents to $2 per year in fees. That's truly remarkable for long-term investing. Well-known companies like Vanguard, BlackRock, which operates the iShares funds, and Fidelity are prominent providers of index funds. When it comes to risk assessment, index funds are generally considered relatively low risk, especially compared to individual stock market investments. Why? Because your money is spread across hundreds, even thousands of companies. If one company struggles, it's unlikely to significantly impact your entire investment portfolio. This is the essence of smart diversification. Here's an important point about how index funds operate. Unlike individual stocks or certain other funds, you can't buy or sell an index fund at any given second of the day and lock in the real-time price. Instead, index funds are priced only once per day, after the market closes. This price is called the net asset value, or NAV. It's calculated by taking the total value of all the assets the fund holds, subtracting its expenses, and then dividing by the number of shares the fund has. So, if you place an order to buy or sell an index fund at 11 a.m., your trade won't go through at that exact moment. It will be processed at the NAV that's calculated after the market closes, typically at 4 p.m. Eastern Time. This is often referred to as the cutoff time. If you place your order before the cutoff, your trade will be executed on that day's closing price. This system makes index funds straightforward and consistent, which is perfectly fine for most long-term investors. It's crucial for your retirement planning to understand these mechanics. So, why are index funds so widely recommended by experts, even by legendary investors like Warren Buffett? Simple. They offer low cost, low effort, broad market exposure, and have historically delivered strong performance over the long haul. They are a powerful tool for wealth accumulation for the average investor. The active approach, exploring mutual funds. Next, let's talk about mutual funds. At first glance, they might seem quite similar to index funds. They both gather money from many investors and spread it across a variety of assets. However, the key difference lies in their management style. Mutual funds are typically actively managed. This means there's a professional fund manager or even a team of managers who are constantly making decisions, which stocks to buy, which bonds to sell, when to adjust the portfolio. Their explicit goal is to beat the market, to outperform a benchmark like the S&P 500 through their expert stock picking and market timing. This pursuit of alpha is central to their strategy. While the idea of a professional trying to outperform the market sounds appealing, there's a significant catch. Active management almost always comes with higher fees. Mutual fund expense ratios commonly range from 0.50% to 1.50%, and sometimes even higher. And here's the kicker. Numerous studies have shown that most actively managed funds actually fail to consistently beat their benchmarks over the long term, especially once those higher fees are factored in. Despite this, some investors still prefer mutual funds. Perhaps they believe in a specific fund manager's unique strategy, or they want exposure to very niche sectors, specific countries, or unique asset types that might not be easily accessible through passively managed index funds. Mutual funds can also offer a greater degree of diversification through their active choices. Major providers like Vanguard, Fidelity, and J.P. Morgan offer a wide array of mutual funds, some actively managed, others passively. It's always important to check the fund's prospectus to understand its management style and fee structure. And just like index funds, mutual funds also execute trades at the end of the day. You can place your buy or sell order at any time during market hours, but it will be processed at the net asset value calculated after the market closes. This means you don't have real-time control over the exact price you receive. Understanding this aspect is crucial for your financial planning. The elite tier, understanding hedge funds. Now, Let's shift gears completely and discuss hedge funds. These are a different breed of investment altogether, a stark contrast to the readily accessible index and mutual funds. The name hedge implies risk management, but in reality, hedge funds are often about aggressively pursuing higher returns, employing far more complex and sometimes riskier strategies. What exactly is a hedge fund? It's a private investment fund that pools money exclusively from wealthy individuals or institutions. We're talking about high net worth individuals here, not the average investor. They invest across a vast spectrum of assets: stocks, bonds, real estate, currencies, and sophisticated financial instruments known as derivatives. Unlike mutual funds, hedge funds have immense flexibility. Their fund managers often use highly aggressive strategies like short selling, betting on a stock's decline, leverage, borrowing money to amplify investments, and complex derivatives trading to try and generate substantial returns. This aggressive approach can lead to incredibly high profits, but it also carries the potential for equally significant losses. This is precisely why hedge funds are typically only open to accredited investors, individuals or entities who meet strict criteria for income or net worth, demonstrating they can handle the elevated risks. And the fees? Hedge funds are famous for their 2 and 20 model. That's a 2% annual management fee on the assets under management, plus an additional 20% of any profits the fund generates. Compare that to the tiny fees of index funds, and you can see why hedge funds need to aim for truly exceptional returns to justify their cost. The high fees and high volatility are why they are not suitable for the average individual seeking long-term investment growth. This is a niche within wealth management. The flexible choice, decoding exchange-traded funds, ETFs. Finally, let's talk about ETFs, or exchange-traded funds. These are often described as a brilliant hybrid, blending the best features of index funds and individual stocks. Here's why. Just like a stock, ETFs trade throughout the day on major stock exchanges. This means you can see their price in real time and decide to buy or sell at any moment during market hours, giving you incredible flexibility to react to market conditions. This real-time trading capability is a significant advantage for those who want more control over their buy and sell points. But like index funds, ETFs also offer instant diversification by pooling investments across many different assets. Many ETFs are passively managed and designed to track a specific index, sector, industry, or even an entire market. So if you want to invest in the S&P 500, you can do it through an index fund, or you can buy an ETF that replicates that same index. This makes ETFs a fantastic tool for getting broad market exposure with a single trade. And the fees? ETFs are known for their low costs, often even lower than actively managed mutual funds. Their expense ratios typically range from 0.03% to around 0.75%, depending on the type of ETF and its management style. Many ETFs can also be bought on brokerage platforms with no commission fees, making them highly accessible for anyone looking to build a diversified portfolio. They are becoming increasingly popular for retirement planning and passive income generation. Making your choice. Who are these funds really for? So, with all this information, how do you decide what's right for your financial journey? For most everyday investors, especially those focused on long-term growth, retirement planning, and simplicity, index funds or ETFs are usually the ideal choice. They are low cost, keeping more of your money working for you. Easy to understand, no complex strategies to decipher. Broadly diversified, spreading your risk across many companies. Excellent for wealth accumulation. Historically, they have proven to be powerful engines for wealth creation. If you have a strong belief in a specific fund manager's ability to consistently outperform the market, or if you need exposure to a very particular niche sector mutual funds might be suitable. However, always be mindful of their higher fees and the statistical challenge of consistently beating the market. Hedge funds, on the other hand, are exclusively designed for high-net-worth individuals who are comfortable with taking on significantly more risk and paying substantial fees in pursuit of potentially higher returns. They are not typically suitable for the average investor's investment portfolio. Your next step towards financial confidence. You now have the knowledge most people take years to figure out. You understand the core differences, the benefits, the risks, and the costs associated with index funds, mutual funds, hedge funds, and ETFs. This foundational knowledge is crucial for making informed decisions about your financial future. The journey to financial independence begins with understanding your tools. I hope this discussion has empowered you to look at these investment vehicles with newfound clarity. If this video has helped demystify the world of funds for you, please give it a thumbs up. Your likes help us reach more people who need this essential financial education. Have questions about what we covered, or want to share your own investment insights? Leave a comment below. I love hearing from you. And of course, for more straightforward explanations and practical wealth-building strategies, make sure to subscribe to the channel and hit that notification bell so you don't miss any of our future videos. Disclaimer: please remember, the information shared in this video is for equipping, educating, and empowering, and not financial advice. Always consult with a qualified financial advisor before making any investment decisions. Your financial future is unique, and personalized guidance is key.